Fizzling out, fast giving up that 8,300 level, the breath already in the negative. Rahul Chadha joins us right now. Rahul, it's a 21-day lockdown for India, but how are things in Hong Kong? Stable yet?
Yeah, I think things are improving. So if you ask us, we started our lockdown late Jan, so things improved a bit towards early mid-March, and then we had people who were returning back to Hong Kong, so that led to some of these cases kind of a pickup further, and that's where it's another kind of more of a work from home, a mini lockdown in Hong Kong. But things are much better from where it was let's say a month and a half back. So I think a similar story plays out for India, if you ask me. We need this much 21-day lockdown. So I think once it happens, after that, people have to exhibit some more restraint for a month or so. And hopefully in 3 months, we should be out of this.
Yeah, we hope so too, keeping our fingers crossed. But can you say that for the markets, Rahul, at this point in time? We've had some tough last fortnight. Does it seem like things are getting any better? Have we seen the worst of it all?
Okay. See, markets are always forward-looking. So if we kind of go back and say in early March, why were the markets getting sold off? Because people were worried that the government would not be able to handle this big deluge of coronavirus cases, which would happen in India. Look, whatever we've seen from government has been swift, quick, and which is where one is positively encouraged by the response of the government. And after that, like the way you said, it's fingers crossed. So I think that's where you saw a 35% correction in Indian equities in last 1 month. So that was a local aspect of it. There was a global aspect also, because we were seeing credit markets literally freeze globally. You had all these risk parity funds which were selling. In India, we saw FIs outflows of a record 6 billion in less than a month. So that all kind of impacted. But now, as we see a synchronized, I would say, a stimulus by governments globally, central bankers acting to unfreeze the credit market, I think globally things are much better than probably a week back. So that's the comfort from an India perspective, that globally things are much better. So you will not have relentless exits of equities which were happening until a week back. Now all the eyes are on the government and RBI. That what does the government do, what does the RBI do to make sure that businesses don't go down under in this 21-day shutdown.
And finally approving that $2 trillion economic relief package. What's the kind of impact you see of that on emerging market flows as well as the dollar?
Okay, so medium term, that's clearly positive. See, right now the risk aversion is so high. I mean, you look at most of the data points; they almost indicate a panic level in terms of attitude towards equities, markets, etc. But as we see some of these high yield spreads compressing, as we see the risk aversion normalizing, what it means is that flows would come to equities, flows would come to EMs. Within EMs, like the way it happens between the large and the mid caps, large caps perform first and then the mid caps perform. What we are seeing in EMs is countries which have tackled the coronavirus well will perform first. So as we talk, we've seen China perform well, we've seen Korea, Taiwan perform well. And in a month and so, as we see India come out of this lockdown well with not too many cases, similar story plays out for ASEAN, like Philippines, Vietnam, etc. These other markets, the smaller markets, would also do well.
Okay. You talked about waiting to see what India is doing as well in terms of stimulus. We're all waiting for that. Would you stay on the sidelines till there's some clarity, Rahul, or would you look for opportunities? If you do, where would it be? IT, pharma, financials, or where would you look?
Okay. So it's always difficult to time, more so in such volatile kind of periods. I think the best thing is that and this is what we've been telling our clients, that the valuations are very cheap. So if you look at India ex-consumer staples, price to book is as low, even below the GFC lows, is as low as 2001. On earnings is one standard deviation below mean. So valuations are in a fairly attractive zone. What you want to see is government seize of the situation. We've seen government do well on controlling this virus by this lockdown. Now we need RBI and Finance Ministry to feel the urgency, and that's where the sooner they do, the better it is, because the more they delayed, the bigger is the amount of stimulus required. So hopefully there are expectations that we should get something over the weekend. That's something keenly watched for. With the basic idea that comes through, then I think there is a deep opportunity in financials, industrials, utilities. Real estate is something we like. So I think consumer staples may give you some upside, but there is better risk reward in other sectors, and this is all contingent on the fact that the virus comes under control in next 30 to 45 days.
Rahul, what about buying life insurance? I mean, I respect it when I use the word. There is going to be no fear and no concern about family care now. In that context, do you think insurance or Indian insurance, global insurance companies, especially life insurance companies, warrant a relook both in terms of assessment and also in terms of need and growth?
Absolutely, Nikhil. See, this is a space we've liked, and these names have got smashed post the budget. I think investors went overboard. Again, in terms of saying that, people are not going to buy life insurance. But I absolutely agree with you, because this is what we are seeing on ground, and that's why we like these names in first place. That the consumer tastes are changing, their preferences are changing, and people realize that, they need a certain amount of insurance for their family to have the kind of livelihood they're having now. Tomorrow, if anything happens to the key earning members. So I think life insurance is a structural story. So if you ask us, apart from financials, I talked about life insurance, some of the energy names, the risk rewards are very favorable. Telecom is something you'll add. So there is deep value in the market. I think if somebody has a 2 to 3 year time frame, it is difficult to see how one would lose money here. The risk reward is very favorable, but obviously there is a tail risk. There is a tail risk that policy response comes too late, policymakers are complacent, or this virus completely gets out of hand.
Okay. What is your understanding on what will happen to IT? One side is this propeller which is coming because of a weak currency. But IT companies essentially is a manpower business. Because of this lockdown, we don't know, no one knows, even they don't know what will be the impact on their entire client delivery and client engagement. So would you rush in to buy IT considering that those are good cash generation companies, or would you wait it out now?
Okay. So again, if we see, people are looking beyond these 1 or 2 months. We were interacting with some of these IT companies, like is happening for most corporate India. It's work from home for everybody. The idea is to just kind of ensure that your run the businesses, processes are working well. And then incremental sales growth is going to be pushed back, is going to be deferred. So these are good cash generating companies, I agree with you, but the upside there would be limited. I think the bigger challenge which we'll face for these companies would be 12 to 15 months from now. If we see the big banks coming under pressure because of near zero interest rates, a lot of these IT companies have close to 30-40% of their revenues coming from BFSI sector. So it's to be seen that those IT spends get curtailed from a medium-term perspective. So near-term, they're okay. They're good cash-generating machines. And if rupee depreciates, they give a good downside protection. But longer-term, I'm not sure of the big upside in these names.
The Bank Nifty and look at Reliance. These are two stocks I would like to point out very quickly, because Reliance for me holds the key for the sentiment. The Bank Nifty holds the key for what's going to happen to the markets in terms of the FI selling and the technicals. So I'm just going to quickly look at the Bank Nifty. Pardon me, I need to use my monitor here. There you go. The Bank Nifty has bounced back. It's more like a V formation for the Bank Nifty, and Reliance also has stopped falling. Rahul, I'm going to put you on a spot and perhaps ask you a difficult one. If you, let's say, have to take a view on the Bank Nifty, which is a combination of private banks and NBFCs, or take a view on Nifty, which is a combination of banks plus 60% of other businesses, consumer, IT and pharma. Where do you think more money could be made in next 1 to 2 years?
Okay. So if we look at this situation, and these are two hypothetical situations we've been discussing. If we go back to what we were discussing, that this virus remains under control and government acts or RBI acts quickly to make sure there are no large-scale defaults in the economy. Clearly, the risk-reward is a lot favorable for Bank Nifty. Outside Bank Nifty, obviously, Reliance offers a promising opportunity because it's gone beyond a pure energy play with what they've done in telecom and retailing, etc. So I think there are interesting opportunities. I think what pulls the Nifty down would be IT and staples. IT because of, again, much lower growth rates in future than in past, and staples because of expensive valuations as a starting point.
How fast, though, Rahul, do you think the recovery in consumer staples is going to be? Because I guess for this quarter, because of all the hoarding up, because of all the lockdowns, and, you know, people have been stocking up, there's going to be that artificial bump up, I guess, that they're going to see in volumes. But what happens post the lockdowns actually get lifted? And, you know, because the supply chain dynamics and the linkages there would get choked up very soon.
Okay. So you're absolutely right. See, if you look at the numbers which were coming for the December quarter, and we had some of these companies which guided on the December quarter, those numbers are still subdued. We've seen a kind of a preemption of demand in March, more so in last couple of weeks, as people stocked up on all these hand sanitizers, soaps, etc. So that's there. But beyond that, I think there is a bigger upside in consumer discretionary. See, consumer discretionary has almost come to a standstill. But from a longer-term perspective, the penetration story remains intact over there. These are the companies which benefit from electrification. These are the companies which benefit from the availability of the consumer finance. The market caps are much smaller compared to the opportunity which is there. So if somebody has a 3-year time frame, I think consumer discretionary offer a much better risk reward than staples. But till the time we have clarity on the spread of the virus, I think there would be investors who prefer the certainty of staples over the volatility of discretionary.
A message coming through, Rahul, and what you're saying. So my next question then is, how long do you see before a recovery, not in the near term, but let's say for those that were already invested to kind of recover the losses that they've seen over this sell-off period? You know, what's the kind of time frame you're looking at? If we look at historically, it's you know, the recovery time has come down, but it's still about 18 to 24 months, even if we take a look at the last 2 times that we've seen this kind of a knock. What do you expect this time around?
Okay. So again, I'll break your question into multiple parts, basically. First is, if we take a China example, in 2003 when SARS broke out, markets trade the second derivative. Second derivative is the growth in cases. So if for next, or for a period of 5 to 7 days, the growth in cases kind of a plateaus or goes down, that's what gives market the comfort that, look, the government has control on the virus spread, etc., and the cases are not going to grow as they were growing in the past. So that's where you'll see the first bottom for the market kind of coming through. And then it is, as the virus recedes, obviously, you'll see that. Historically, we've seen, I think, 9 to 12 months is fair where markets recover. In the past, look, what you're probably alluding to is a demonetization event. But what is different now is a big global stimulus. This was the kind of stimulus which was given around GHC time. If US gives a 2 trillion stimulus, that's close to 10%. Eurozone, Germany was somebody which was holding back. Now we've got Germans coming ahead with a huge amount of stimulus. So the global stimulus is huge. The monetary balance sheet expansion by central banks is huge. So with that backdrop, it would be fair to expect that, look, markets lost 35%. We can get those gains back in next 12 to 15 months. I think that can come back. What one would also like is, see, we're going in a world which we have a lot of these external shocks coming through, whether we had a US-China trade war last year and then we have this coronavirus. It may not be a bad idea to have a market stabilization fund. See, most countries do that. Again, look at China. They had close to 80,000 cases. They had foreign outflows of $15 billion from their local market. yet the market was down only 10%. And in India, we are down 35% on barely $5 billion of outflows. So a $5 to $10 billion of market stabilization fund would do well from a medium-term perspective. Because else what happens is, because of this volatility in markets, most investors then focus only on large caps. And then the small and mid caps are deprived of capital. So from a longer term, it may be a good idea to think through this, that look, let's put a market stabilization fund in place, and that leads to a healthy functioning financial system, basically.
Rahul, thanks so much for joining us this morning and talking us through some of the implications of what we're currently seeing around the world.